Hey guys and girls, it's Eimo from the room, and this video is regarding risk management, and it's inspired by many members in the room as well as newbies, and this video is dedicated to members such as Raphael, Daryl, and Cookie Monster. It's just really devastating to see them lose their account in just a few bad trades. And this is all because of improper risk management. And I hope after this, you guys will have a better understanding and apply this risk management properly in your trades. Okay, so for this video, I will need to use an Excel sheet. It's just really some very simple calculations. But if you happen to not to have an Excel with you, a pen and paper, as well as a calculator should do the job. Okay, let's go. So for this calculation, you will only need 5 columns. Capital, which is the amount of money you are willing to invest into your Forex trading. Risk per trade. Stop loss in terms of pips. Amount risk per trade in terms of dollars or pounds. Or depending on whatever currency you may be using, and dollars per pip. Okay, so first let's go through this. Let's say we are using $100 to start off our Forex trading, and we are risking 2%. 0.02 in this case means 2%, and 0.03 means 3%, 0.04 means 4%, and so on and so forth. And this brings us to our rule number 1 of risk management. Okay, the risk per trade is highly recommended to be kept between 1.5 and 5%, especially if you are a newbie or you haven't been winning consistently. This is very important. So this is 1.5 is like the lower cap, and 5% is like the higher cap, depending on your risk appetite. Okay, so for this we are using 2%, and stop loss we are using 20 pips. And for these two columns we are using a simple formula to calculate. Alright, let me show you guys how do we do it. The amount risk per trade would be done by using the capital multiplying by the risk per trade. So 100 multiplied by 0.02, which will give you $2. So you are risking $2 for this trade, for every trade you are taking, with a stop loss of 20 pips. Okay, so this means that in the worst case scenario, when this trade goes against you and hits your stop loss, you will lose $2, which is 2% out of your $100 capital. And then let's move on to the next column, which is dollars per pip. So how do we calculate this? It's actually really simple. So it's by using the capital multiplied by the risk per trade, and then dividing by the stop loss, and you will get 0.1, which is equivalent to 10 cents per pip. Okay, I hope you guys got that. And alright, let's do another example. So let's say, by the way, we are only required to fill up these 3 columns. Alright, these 2 columns will be done automatically by the formula. Okay, so let's say we are doing $1,000 capital with a risk, let's say a much higher risk appetite. I'll give you a 5% per trade and stop loss of 50. Okay, maybe it's a long-term trade that we are doing for this setup. And then to get this, we just need to drag it down and drag this down. So we will risk $50 per trade. In the worst case scenario, touch wood, let's say our trade go against us and it hits the 50 pip stop loss, we will lose $50, which is 5% of our capital, $5,000. And how much will we be doing per pip? It's $1 per pip. Okay. Yes, and there's a rule number 2. And this is equally important as rule number 1. Because at any one time, it is only recommended to risk about 10% of your account, of your whole account. So let's say if you respect rule number 1 but not rule number 2, you can also blow your account by taking multiple trades which expose you to high risk. Okay, let's give an example. During happy hours, we like to take the UJ up, the UC up, and the GU down, EU down. So we click on them. So we have at one time we have 4 trades running. Let's say we are doing 2% risk for every trade. So in total we have 8% of our account risk at that time. Yeah, it's okay. But however, when we see something like maybe the GU has another super pink signal which you really like, and you decided to take it more, like maybe 3 times, and this will be an issue, because when you take that and having the 4 previous taken positions still running, you're exposing yourself to a 12% risk, which breaks this rule. So please bear that in mind, and if you have any question, you can just let us know in the chat room. We will help you on this part if you don't understand. Okay, so let's move on to further more examples. Let's do this. Let's say we go to our trader preference and quick trade settings, and we set our stop loss to 50 pips according to this setup. Okay, $1,000 per pip with 5% risk and 50 pip stop loss. And then we pull out our currency pair. The lot size is 10k, so we double check $1 per pip, and it's 5% balanced risk. If you see this, you're good to go. Alright, that means you have done the correct stuff, the proper risk management. Okay, and one more thing I'd like to cover on is regarding the other currency pair example, the UC. When you're doing the same configuration and you do a 10,000 here as in the lot size box, you would see that it's only 80 cents that you are doing, and it's only at 3.99%. Now that's because the currency fluctuates, so each time before you take a trade, remember to double check. Well, it's okay if you risk lesser, but there are scenarios where you will risk much more than what you originally planned to do, which is dangerous. Okay, so let's see the UC. If we do a 12,000, it will be 4.79%, and if we try and do a 13,000, it will be 5.19%. And so if you're a newbie or you're still trying out how this thing works, it's best to stick to the one lesser than your originally planned risk per trade. Alright, so that's all I have for you guys, and I see you guys in the room, and I hope this has been useful to you guys, and take care everyone. Bye.